Good morning, I'm James Lopez, President at HomeFi Corporation, and this is today's mortgage and real estate market update. There's a lot of information to cover today, similar to yesterday, a lot of news that has come out this week, and so today I've got some notes with me, and I'm just going to have to continue to check out some of these notes, a lot of numbers in here, so just want to get all this data out to you today so that you've got an idea about what's going on in the market this week. All right. First off, we'll start into pending home sales. Pending home sales measures signed contracts on existing homes. The data came out for March, and the data was expected to be down quite a bit. The expectation was actually for pending home sales to be down 1.8%. A lot of headwinds right now in the housing market, as everybody knows: rising interest rates, rising home values, lower inventory, all the things. And so, the expectation was pending home sales to be down by 1.8% in the month of March. And this is the first time we've really gotten a good reading since mortgage interest rates really kind of spiked, okay? But expectations, it was better than expectations. It was only down 1.2%. So that's a much better than decline than what was expected. And again, in the face of all the headwinds and challenges that the housing market is kind of seeing, that data is actually not bad data. That's kind of good news, the way that we see the housing market and everything. Now, also, if you look at a longer time frame of signed contracts, if you go back, a year, 2 years, we're really at still very strong levels. We're just off of the crazy highs that we saw right after the post-COVID, rush that we saw for people to buy homes. So we're still at strong levels. We're just down from those crazy highs from the post-COVID rush. CoreLogic released their single-family rent index, and this number showed that rents increased 13.1% year over year. That's quite a bit. This report includes both new rents and renewals, which came in between 6 and 8%. Renewals came in between 6 and 8% year over year. And listen, whenever we're talking with customers and to our real estate friends that watch this video, when you're talking to your customers and they say, hey, I think I'm just going to rent. It's hard to buy right now. You can't find the right house. Whatever their objection is. The thing is that you can point to this and say, listen, it's expensive to rent right now too, and it's hard to find places to rent as well. So whenever you're talking to your customers, you can just always remind them, hey, rents are up right now too, and you know what? Whenever you rent, you don't get the benefit of amortization, you don't get the benefit of appreciation, and really you don't get the benefit of a fixed housing cost, right? So whenever you have a 30-year fixed mortgage, your housing cost, for the most part, it doesn't go up. It stays what it is unless there's changes in insurance and taxes or something like that. So renting is not necessarily better than buying right now. And so for those of us that have customers that are on that fence right there, just remind them, rents are up right now year over year as well. Now, Redfin released a report, and they talked about home buyer competition, and everybody knows the past few months have been a little bit crazy as far as just the limited inventory. Multiple buyers are going after the same properties because there's limited inventory and there's bidding wars and all this kind of stuff. For the first time, this report from Redfin showed that home buyer competition is actually decreasing just a little bit for the first time in 6 months. All right, but there's still bidding wars that are happening, still multiple offers, and over listing price, scenarios are happening. All that kind of stuff is still going on. But that's kind of cooled off just a little bit. All that said, with inventory, and we've been talking about it for a few weeks now, with inventory the way that it is, and demand the way that it is still very strong, we're still going to see supported home prices, right? Because the demand is too strong. So we're not going to see the 20% appreciation we don't think that we've seen from last year, but we do think it's going to be in the high single digits, 6, 7, 8%, somewhere around there. And so we still think that home prices and home values are going to be supported. MBA released their mortgage application data for last week, and application volume decreased 7.6% on purchases last week, and it's down 16.6% year over year. But when you factor in the number of cash buyers that are out there in the market right now and buying and not taking on a mortgage, applications were down about 13% year over year as opposed to the 16.6% number. So just something to keep in mind and notice about that. Now, one thing that we've talked about a little bit is the idea of an ARM, and An ARM, it stands for an adjustable rate mortgage. And what an ARM does is it typically allows you to lock in to a lower interest rate for a certain period of time. Typically we see a 5-year ARM or a 7-year ARM or a 10-year ARM. There's even 3-year ARMs. But ARMs are a great way to get a lower interest rate right up front, kind of improve your buying power too as a buyer, because a lower interest rate means a lower payment. All right, so on average, the 5-year ARM, the average rate for the 5-year ARM last week was 4.28%, which was about 1.125% lower than the 30-year fixed. So that's a huge difference, right? So at 4.28, on an ARM, the 30-year fix was at about 5.28, right? So it was much higher, a percent higher, a little bit more than a percent higher on the 30-year fixed. So the ARM actually gives you an opportunity to have a little bit more buying power as far as your payment and all that kind of thing goes. But a lot of people get scared about ARMs because they're worried about, well, what's the worst case scenario? Well, in most cases, an ARM can even be better. In the worst case scenario, it can be better for at least 7 years than a 30-year fixed, even with the worst case scenario. And the reason why is because adjustments to the rate are capped based on a certain time period and based on the index that they're following. So it's a little more complicated, but really about 7 or 8 years, if you're in an ARM, you'll be in a better rate situation than you would be with a 30-year fixed rate on an ARM. Now, then you can always refinance once rates start to come back down. So you can get yourself into an ARM, as an option at the 4.28%, somewhere around there. Get yourself into an ARM in 2 or 3 years. If rates come back down into the 3s, refinance, and you're in a better interest rate position than you were if you'd have taken that 5% on the 30-year fixed. So just something to think about. And as a result, by count, ARM's share of applications was up 9% last week, and down and 17% based on total dollar volume for all of the applications. Now that's double what we saw 3 months ago. All right, so just some interesting things to think about there as far as the ARM goes. If you look at rising rents and everything, and all the inventory issues, all that kind of stuff, if you get an ARM, you have more buying power. All right, and it's an easier way to just buy more house, just depending on your situation. So something to think about. Lastly, we're going to jump into the mortgage bonds today. Mortgage bonds are down this morning. Let's see real quick. They're down about 16 basis points right now. 10-year yield is up about 3 basis points. What that means for mortgage rates today is that mortgage rates are going to open probably a little bit worse than where they closed off yesterday, but we did have repricing throughout the day yesterday. So interest rates should open maybe about where they were yesterday, maybe a little bit worse. But really what we have going on this week as far as news, the biggest news item this week is going to be coming out tomorrow. It's the PCE, it's the Personal Consumer Expenditure Price Index. And this price index is the core reading for inflation that the Fed is really taking a look at. That's the headline newsmaker, but also today GDP was released, gross domestic product, and GDP was actually down 1.4% in the first quarter, which is a pretty big move. And so bonds are kind of pushing against those headwinds, if you will, and just having a little bit of a tough time rallying today and going into green. Now we're still in that window of support and ceiling that looks like we're setting a new trend line, even though we're down a little bit today. We've had a couple of up days, and so even though we're down a little bit today, it still looks like we're resetting that trend and rebuilding that foundation. So instead of this trend line that's going like this, it looks like we're starting to level out just a little bit. We'll see what happens throughout the rest of the day and tomorrow. Hopefully that trend continues, and if it does, that means that we should start to see a little bit less pressure on mortgage interest rates as far as increasing, and maybe a little bit of a leveling off, and possibly even start to see some of those interest rates come back down. All right, that's all the news that we have for you today. Thanks for bearing with me. There's a lot of information, a lot of data. If you have any questions, please let me know. Like, comment, and subscribe. Go over to Facebook. We are going to be sharing some infographics on the pending home sales over there on Facebook right now. So I hope you have a wonderful day, and we will see you tomorrow. Thank you.